welcome back. You came back. That's good. All right, so today is Tuesday, August 26th. We are going to start chapter 1 today. Has everybody been able to get their Tax Act downloaded? You've been able to get started on that stuff? Yeah, okay, I know Kate has. Yes, okay, all right, good deal. So that's due Thursday night, don't forget about that. I did just send out an update, the discussion board thing. You don't have a discussion board. I know I sent out a announcement reminding you what's due this week, and in that was discussion board. No, you don't have a discussion board. That's only for the online students. Online students have a discussion board. In-person students have an attendance. Your attendance is your discussion board. So anyway, we are gonna get started. Let me see if I can do this through here. So you'll notice that I put in your, I've got just like a quick jump to for the chapter. So hopefully that's helpful to everyone. All right, so I don't use the PowerPoints. I don't like the PowerPoints for this class. What I do is I'm not reading to you, but I'm using the chapter, what they have in the book as I'm following along what they're doing, giving you some additional, giving you explanations as we go along. That doesn't excuse you from reading it, because I'm not going to read it to you, but that's generally what I use for this class, just because I really don't like those PowerPoint, their PowerPoint slides. Feel free to use them. Feel free to use them as a study aid, what have you, but I just don't like how they're organized. So in chapter 1, we've got 6 different learning objectives here that we're going to talk about. First one is kind of an overview of taxation, the different types of tax structures that we have. And this is important because the income tax structure differs from like Social Security tax and Medicare tax in its structure, meaning how we apply the tax, how we actually do the calculation of the tax. And so I'm going to go through those. There are 3 main tax structures. So we're going to talk about those. I think I probably gave you a little intro to this when we were in payroll, but we're going to review that. And then we want to talk about this concept of marginal versus average tax rates. So when we talk about the tax structures, you'll notice that the income tax uses this concept called marginal tax rates, meaning your tax rate varies depending upon what your income is. And so what happens there is that it makes your marginal tax rate different from what your average tax rate is. So we'll talk about that and why that's important. And then we're going to look at this simple income tax formula that I alluded to last week. And then we're going to take a look in detail at the 1040 form. So what is on the 1040? How is it structured? Where to find things? Again, you're going to become really familiar with the 1040 tax form as you're doing your Tax Act problems and as you're doing your tax return problems in your homework. We're also going to calculate then at a very basic level tax liability. So how much tax do you owe? Based upon different factors, and I'll show you on the 1040 return exactly where that is located. Those 4 learning objectives are what I'm hoping to cover today. On Thursday, we'll finish up talking about different types of tax authority, meaning, I have to pay tax. Who says? Who says I have to pay tax? Where does that authority come from? So we'll talk about the different types of tax authority, as well as this IRS Circular 230, which is a it's a publication that the IRS puts out that gives requirements, states what the requirements are for paid tax preparers. So as well as what different penalties there are. So there are rules. If you are going to get paid to prepare somebody else's tax return, there are rules that you have to follow in order to do that, in order to submit that tax return then with the IRS. And so we're going to look at what those rules are. So that's kind of summary of what we're doing in chapter 1. So let's get started. I can't reach up there. Well, maybe I can jump to it here. There we go. All right. Okay. So these tax structures. We've got these 3 different types of tax structures. Progressive tax structure, proportional tax structure, and regressive tax structure. And with taxes, I will tell you, this is the basic formula for taxes is you have your tax, that doesn't work. Let's see if I can get one that works. Good. You have your tax base, which is the amount that is being subject to tax. So if you have income of $10,000, that income is your tax base. That's the amount that's going to be taxed. Okay? So ultimately, this is what we multiply by our tax rate, represented by some percentage, to get to our tax, the amount of tax that we actually owe. With a progressive rate structure, as the base increases, the rate increases. So for progressive, let me put this down here. As our base increases, our rate increases. So for example, we'll use the example of the $10,000. If our tax base was $10,000 and our tax rate was 10%, we would then have a tax of $1,000. But then if our tax base increased to $20,000, our tax rate then also increases maybe to 12%. So it's not just the tax base that's increasing, it's the tax rate that increases as well. That's progressive taxation. As the base increases, the rate also increases. With a proportional tax rate structure, it doesn't matter whether our tax base increases, decreases, or stays the same, our tax rate doesn't change. So, and I'll give you some I'll give you some examples here in a minute. So as that base, like I said, if it increases, doesn't matter what happens with the base. That rate is not going to change. With a regressive rate structure, as our tax base increases, our tax rate actually decreases. That doesn't seem fair, does it? So now our tax base is $20,000 and our tax rate instead of 10% is now 5%. That doesn't seem fair. What we have in our minds is this progressive tax structure as being fair. That the more you make, the more they take. Okay? This is regressive. Our income tax structure is progressive. Federal, I should say. Federal income tax structure is a progressive tax structure. So as your tax base increases, your tax rate is going to increase. Proportional would be something like Medicare tax. Sales tax would be another example. Tax, sales tax. Sales tax, if you buy something, we have 7% sales tax. If you buy something that costs $1,000, it's a 7% sales tax. If you buy something that costs $10,000, it's a 7% sales tax. If you buy something that costs $2, it's a 7% sales tax, right? Doesn't matter how much it costs, that sales tax is the same. Medicare taxes as well. If you recall from payroll accounting, Medicare tax, from the first dollar, that tax, the employee is going to pay 1.45%. When it goes up, we're not talking additional Medicare tax. I know a lot of you remember that additional Medicare tax. I'm just talking about standard Medicare tax. If you're making $1 million, it's still 1.45%. Okay, so that's a proportional. That's also known as a flat tax. Okay, we know that we think of that as a flat tax. Regressive tax structure, that unfair tax structure, we actually have that as well. If you recall Social Security. Social Security with Social Security tax, I can't see this right now. I'll move this over here. Social Security tax, remember, we have a tax base for Social Security tax. Changes every year. I think this year it's like I don't even know what it is off the top of my head this year because I'm thinking about last year with what I'm teaching. 168 something is what it was in 2025. So you're taxed at the 6.2%, the employee pays 6.2% up to that Social Security base of 168,000 and change. And then after that, there's no tax on the income over and above that. You recall that concept? So that is a regressive tax structure. With our progressive tax structure, this is kind of what our rates look like. Now, with our tax structure though, it's not, we have cutoffs, we have kind of like buckets. So up to, and this is for married taxpayers, the filing status, as the filing status varies, these rates will be different as well, okay? So for married taxpayers, and this was for 2024, up to $23,200 for our tax base would see a tax rate of 10%. The amount over that, $23,201, these are our marginal rates. The amount over and above that are taxed at 12%. However, not the entire amount is not taxed at 12%, only the amount over this cutoff, okay? So only the amount over and above that cutoff. So this is why it's a marginal rate. The marginal amount over and above what our cutoff is then subject to the next tax for up to $94,300. Starting at $94,301 up to $201,050, there's our tax base. We had a marginal tax rate of 22%. So you can see, as that income, that marginal income goes up, as those buckets increase, the amount in that bucket is going to be taxed at a higher rate. Does that make sense? Okay, so, and this will help to explain when we talk about marginal versus average tax rates. These are our marginal tax rates. These are not our average tax rates. We can calculate our average tax rate if we know, once we have figured out what our tax is. And I'll show you how we're going to calculate that tax. So it's progressive because the rate gets larger as the taxable income or the tax base increases. The very high, so we started a tax rate of 10%. So everything, so $1, and this is our taxable income, this is our base. Taxable income, lowest amount is at 10%. Highest tax rate then is at 37%. So here's an example of how that would be calculated. We've got Mary and George. They're married, which means because they're married, we can use this table up here. They have taxable income of $389,000. So in order to calculate what their total tax is, we're going to look at the different buckets. Well, so the first $23,200 of their income is going to be taxed at 10%. That's easy enough to calculate. The next bucket is taxed up to $94,300. See, $94,300 is taxed at 12%. So we'll take the amount in that bucket and multiply it by 12%. Well, they've got more than just the $94,300. We got to go into the next level, right? So the next bucket, which is from $94,300 to $201,50, is at 22%. So this amount we'll take, so in order to figure out how much is in that bucket, we subtract the lowest amount in there from the highest, the top number, and we take 22% of that. 23,485. Do the same thing. 24% tax rate. They absorb all of that because they're at $389,000, which is over this, right? So it means they've got money, all of their money is absorbed by this one, this one, this one, and this one, and then it goes a little bit into this bucket, right? 389,000 is marginally into this 32% bucket. So we're going to take all of the amount that is absorbed here in that 24% bucket, multiply that by 24%, 43,844, and then the last amount. So we will take that 389,000 minus 383,900. So everything, we go into this last bucket by what? $6,000, $5,000. We're going to multiply that by the 32%. That's the marginal rate. For a total tax there of $1,632, then all of it is added together to get what their total tax is. So this is, so their base, as that base increases, the rate is increasing, but they still get the benefit of the lower rate for the amounts that are in those lower marginal brackets, those lower marginal buckets, sorry. Does that make sense? You sure? You don't look too confident. Let's make one up and we'll do it ourselves, okay? All right, so let's see here. I don't have a calculator up here with me because my phone's being used, so you guys are going to have to help me with the calculations. But let's say we have a married couple, married filing jointly, which is our filing status for this table. And let's say that their taxable income, this is their base, is, let me see, $125,000. Okay. How much of that $125,000 is in the 10% bracket? Yeah, all of it, right? So 23,200 of that 125,000 is going to be subject to 10% tax. This one's easy to do. I don't need your calculator for this one. The next bracket goes up to 94,300. So we're going to take the entire amount that's in there, so 94,300 minus the 23,200, which is how much? Somebody do the math for me. $71,100. So in this bucket is $71,100 times 12%. So you have to do that math for me too. I'm not a savant. $8,532. All right. Well, they made more than 94,300, right? They're into this next range. So we'll have to take the 125,000 minus 94,300, which is how much? 3,700, okay? Multiply that by 22%. So they're in the marginal 22% bracket, okay? That's their marginal tax rate. And how much is that?
$6,754.
Add all that together. 6, 8, 10, that's a 0. So 10, 16, 10, $17,606 is their total tax liability. So we know that their marginal tax rate is 22%. If we want to figure out what their average tax rate is, which you've got some homework problems that are going to ask you to figure that out, so we should probably learn how to do that. What we're going to do, I mean, it's an average, is going to be the total tax liability, 17,606, is our total tax liability, divided by our taxable income. What does that get us? Is it right? Is it right?
Decimal. The decimals.
Okay, give me the decimal.
Yeah. 0.140848.
Okay, so we've got 14.08%.
Yeah.
Is their average tax rate. Their marginal tax rate is 22%. The marginal tax rate is the amount, is the tax rate of the last dollar that is being taxed. The last dollar that's being taxed is the $125,000, right? That dollar is going to be taxed at 22%. But overall, all of their income is going to be subject to 14.08%. Want to do another one? Do you need to do another one? Yeah? Okay. So, let's do, can I erase this? We good? Okay. We'll still use keep in mind that this chart changes based on filing status. This is it also changes based on year. So, if you're looking at 2025, you would be able to look up the 2025 tax brackets for married filing jointly. What would change is not these rates, but the ranges would change. So less income, and what they do is they index it for inflation, so there would be more income at the lower rates. So let's say, you guys can give me an income amount. Give me an income. $270,000. Okay. So there's our taxable income. First bracket, right? So we got the first 23,200 is going to be taxed at 10%. 2320. Next bracket we go, so 270,000, we're going all the way up here to the 24% bracket, aren't we? So we want everything that's in this second bucket. So 94,300 minus 20, I'm running out of space. 94,300 minus 23,200. What was that again?
71,100.
71,100?
Yeah.
And that was 12%. And what was the amount here? I can't remember. I shouldn't have erased all of it.
8,532.
32. Okay. And then we get to the next bucket, and we're going to absorb all of that as well because we're over the 201,050. So 201,050 minus 94,300. How much is that? $106,700 and what?
50.
50. And our tax rate is 22%. So let's do the math on that.
$23,485.
23,485. All right, now we've got our final bracket because we go into this range, but we don't exceed it, right? So we'll take our taxable income, 270, minus the top of the last range, 201,050. Remember, we're just trying to figure out how much of the income in each of these buckets is going to be subject to that tax. So what's 270 minus 201,050? 950. And our tax, what? 68,000. Okay, times 24%. What's that? 16,000. 48. 8.
Yes.
Okay. All right. Then we're going to add all of these together. You guys, somebody add that up for me. I don't have to do it in my head.
$50,885.
885.
Yeah.
Total tax liability on that 270,000 of taxable income, 50,885. Marginal tax rate is 24%, because the last dollar that they earned is going to be taxed at 24%. But their average tax rate is always going to be lower than marginal, unless you're only in the 10% tax bracket. Then they're going to be the same. But the average tax rate's never going to be lower than the marginal tax rate. So average, remember, we're going to take our total tax liability, 50, oops, confuse things, 50,885 divided by our taxable income. What's that get us?
18.85%.
tax rate is 18.85%. Questions? So what all you're gonna do is when you're actually doing this, you gotta find the correct table, right? So just like we did with payroll, you gotta make sure you're on the right table. And then you're going to take the taxable income, figure out what bucket it stops at, like where does it end, and every other bucket you're gonna have to calculate them, how much tax that is. Now, I'll give you a little hint. They if you look at the back of your book, in fact, let me find it. Let's see if I can. I shouldn't do this because you should have to do all the calculations, but
Tell you the total for each bracket.
so if you look, so here's the Mary. What they do is they've done all of this work for you, these three. They've done that calculation. The only thing you have to do is the last line here and add it to their total. So let's look at this. I'll show you how this works. So we're at 270. So if taxable income is over but not over, okay, so over 201,050 but not over 283, we're going to take 34,377 plus 24% of the amount over 201,50. We've already done that work here in this last one, right? 16,548. So 5, what do you have here? 7, 12. Is that right? Did we do this right? I got 5885. This is saying 925. So this is saying 5925. This is 5885.
It's because you did 201,050 and it's 051.
201. Oh, is it 0?
051.
No, it's 050. You would subtract the 050.
You're 34,337 instead of 34,377.
Sorry, 34.
337.
Oh, there we go. Thank you. Right on. Good catch. So all they're doing with this, like I said, this amount here, they've already done the math for these three lines. This is in Appendix F in your textbook. Okay. We're gonna do more. Don't worry.
Don't you worry.
So proportional tax rate structure. So that's our progressive tax rate structure. The more you make, the more they take. Proportional tax rate structure is a flat tax. So as the base increases, the tax rate doesn't change. They use Medicare tax as an example, regular Medicare tax, additional Medicare tax. Well, additional Medicare tax is also proportional because once you reach the 200,000, well, I guess it would be considered progressive because from 0 to 200,000, it's a 0% tax rate. Over that would be, 250 or 200 would be the 0.9%. Iowa now has a flat tax. Iowa used to, until last year, Iowa had a progressive tax. Now we have a proportional tax structure for individual income taxes. One tax rate regardless of taxable income. Most of our work in this class is going to be focused on figuring out what this number is. What is our taxable income? Because we have to arrive, I gave you that here and we gave it in the problem, but we have to figure out what this taxable income amount is. Because there are a lot of things that go into this calculation, okay? You're gonna find that, I mean, at first, calculating this might be a little bit of a challenge, but this will be the easy part. This is the hard part, figuring out what this amount is. Okay, so proportional is flat tax. Regressive, again, Social Security tax. Okay, there it is, 68,600 is the Social Security tax base for, I guess that's for 2024. I don't know what it is for 2025. It's gonna be 170 something. So remember, the tax rate for an employee up to 168,600 is 6.2%. After that, additional income, there's no Social Security tax on it, right? So that's the, all right. So do we think we have down progressive, proportional, and regressive? Make sense? Okay. Well, let's move on to the next part.